Let's quickly talk about the Capital One Discover card deal, and the question is, how is this going to affect you as a cardholder? Let's talk about that. So here's a review I want you to pay attention to. So first of all, Capital One has announced recently. I mean, this was last week. Has announced that it's buying over. It's actually buying Discover, and so the question is, how is that deal going to affect you as a cardholder, especially as a Discover cardholder? The thing is that you have to understand, will you still be able to use your Discover card? Yes. Yes, because the proposed merger could take a year or two or more to gain regulatory approval. So in the immediate term, do not expect any changes as the deal is being reviewed, okay? And the companies have not yet disclosed how they might change their product mix. So it's possible Capital One might issue new Discover cards highlighting its name instead of Discover's bright orange O logo, similar to how it issues its Visa and MasterCard credit card. So again, it's all about how they are thinking about changing their business model. But you can still use your Discover card, not a problem, until the deal is approved from a regulatory perspective. And what if you use a Capital One Visa or MasterCard? Well, nothing has changed there too, because Capital One remains actually one of the largest issuers of Visa and MasterCard credit cards in the nation, and that is not expected to change, at least for some time now. And this is kind of cool. And what Discover and Capital One management have said is that the deal brings together two strong brands with enhanced ability to accelerate growth. However, it's really important to understand that everything can change depending on what the company decides. But for now, you can still use a Capital One Visa or MasterCard, not a problem. And if you keep your existing credit cards, what is the thinking behind the deal? Well, Capital One has grown rapidly since it was founded in 1994, and currently is one of the nation's largest banks, because see, Capital One is not just a credit card issuer, it's also a bank. So it's important to really understand. So a big part of that growth has been its issuance of credit cards by the nation's two leading card networks, Visa and MasterCard, with a focus on subprime customers who carry balances. Now, with Discover, it will also own its own network, similar to how American Express issues its own cards. So this could actually add another layer of revenue to Capital One. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. Now, let's actually dig a little deeper here. What is actually the advantage for Capital One of owning a credit card network, such as American Express, for instance? Well, Discover, when you think about Discover, the company originated by Sears in the mid 1980s. So Sears did it to get into the financial services business. But right now, Discover has a network of 70 million merchant acceptance points in more than 200 countries and territories. So this is kind of cool. And so Capital One has said that this is actually a key foundation in its quest to build a global payments company. Okay, and you have to understand, Discover actually is interesting to Capital One, but Discover remains the smallest of the four U.S. global payments networks, and also trailing American Express. So the merger could actually result in Capital One's expansion, providing more competition to Visa and MasterCard, which are sometimes referred to as a duopoly in our view, okay? And now, are there any downsides to the deal? Of course, yes. I mean, what we have seen in our research is that consumer advocates are wary of large mergers, especially in the financial services industry. And they say that the consolidation can lead to higher costs for consumers in the form of interest rates and fees, whether in the insurance, mortgage, or credit card markets. Also, what we have seen in our research is that critics are saying that larger financial institutions tend to have inferior customer service. And so Discover, which has really focused on prime customers with better credit ratings, has a reputation for superior customer service. So it is what it is. And so right now, do we have opposition at all? I mean, is anyone opposing the merger? Well, it really depends on whom you're asking. So the National Community Reinvestment Coalition actually came out immediately against the deal, noting that they actually said that small banks and credit unions actually could suffer They said the deal is not likely to create public benefits that outweigh its detrimental effects. So on that basis, they're opposing the deal. Okay, and also there were some concern from Senate Democrats, including Ohio Senator Sherrod Brown, that they actually looking at the deal closely so that it doesn't enrich shareholders and executives at the expense of consumers and small businesses. So you can see that in terms of opposition, you have opposition from Congress, especially the Senate, but you don't have a large public opposition against this deal, at least as of the date of this show. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about what the Capital One Discover deal mean for you as a cardholder. So as a cardholder, you basically, if you are a Discover cardholder, you just have to wait and see. Okay, you have to wait and see, and it's one of those things where a lot of folks are saying that the shareholders will actually will take advantage of the deal because the merger is structured as an all-stock deal with Discover shareholders receiving 1.0192 Capital One shares for each of their Discover shares. That would give Discover shareholders a 26.6% premium based on Discover's closing price, their last closing price. Okay, and when the merger closes, Capital One shareholders will own about 60% of the combined company, and Discover shareholders the rest. So 40%, 60 to 40. So it's sort of the delta you need to think about. And now, what is the chance that such a large merger will be approved by regulators? Well, it really depends. It depends on the trends in the economy. It depends on what the regulators are seeing as risks. Okay. Now, the deal could actually come under increased scrutiny by the Office of the Controller of the Currency, the OCC, under a proposal that was sent to the authorities last month. And basically, what the regulators are asking is they want more time to review the deal and expand their criteria for reviewing mergers. Okay, and also the Federal Reserve Bank has indicated that it may strengthen merger oversight after the crisis last year that really saw the failures of Silicon Valley Bank and other regional lenders. So the bottom line here is that you're not speaking about, when you think about Capital One merging with Discover, you're not speaking about the same level of risk that we had last year with Silicon Valley Bank, but it's just one of those things where the authorities are thinking really clearly as to what could go wrong, right? It's one of those things where if you're doing hypothesis analysis, you want to see what could go wrong. And when you engage in this type of conjecture, you want to make sure that you are on the right side of history here. But the bottom line is, based on our research, this type of deal usually goes through. It might take a year, it might take 2 years, but in the end, it will go through and will be approved. Now let's talk about how each party is actually thinking about the deal. Does Capital One have anything to worry about? Well, Capital One is in a strong position right now in terms of credit card issuance, but also, as I said a little earlier, Capital One is really a bank. It's not just a credit card issuer. I mean, they do a personal credit, they do business credit, not a problem. I mean, kind of similar to Discover, by the way. So Capital One was actually fined $80 million by the OCC in 2020 for lapses in its failure to establish what it called effective risk assessment processes prior to moving information technology operations to the cloud. So IT operations to the cloud, and then failing to correct the deficiencies in a timely manner. So it's one of those things where you have operational setbacks. And Capital One was previously fined $100 million in 2018 by the regulators for deficiencies in the bank's anti-money laundering program. So Capital One actually can worry about that in terms of the deal receiving increased scrutiny from regulators. What about Discover? Because Discover is not just it's not a quote unquote a saint party. So the company has just gone through management turmoil, and so the recent CEO, so Roger Hochschild, resigned in August after the company said it misclassified some credit card accounts into its highest pricing tier as far back as 2017, which really resulted in merchants being charged more for accepting the cards for a payment. Okay. And so it's one of those things where, I mean, nothing really major, but it's one of those things as a card holder, you have to really, you have to be aware of the fact that there are things happening in the background in terms of whether the bank will receive regulatory approval or not. Bottom line here is what, when we talk about the Capital One Discover deal, we are speaking about from a cardholder perspective. We're really summarizing the fact that the deal will go through. The deal will actually create better terms and conditions for existing cardholders. There will be some kind of there are two ways to look at things here. Either they keep the Discover cards as they currently are, or they can rebrand Capital One cards. I mean, they can rebrand Discover cards as Capital One cards and actually just have new accounts altogether. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about what the Capital One Discover deal could mean for you. Now, one thing I want to say here is that you need to really understand that basically Capital One is really eyeing Discover's valuable payment network, right? So aside from being a card issuing bank, Discover is also among the 4 primary payment networks in the US, along with Visa, MasterCard, and American Express. Though really it's one of those things where if you are a payment processor, you basically have most credit and debit card transactions are processed, okay? So while Capital One intends to keep the Discover credit card brand separate, it also plans to move its debit processing over to Discover's payment network, as well as some of its credit card processing. So this is kind of cool. But bottom line is, don't forget, it's not a done deal, right? So it has to go through a regulatory scrutiny. It's not a done deal, but ripple effects may eventually reach you depending on where you find yourself on the equation here, because you can have new products, you can have worse terms. Everything depends on how they actually proceed with their business, with their new business model. You can have updated account numbers. So if your Capital One credit card is among those that get transitioned to Discover, or even if the opposite happens, you can expect to receive an updated credit card and, most importantly, a new account number. And currently, Capital One credit cards largely run on either the Visa or MasterCard payment networks. So when you think about it, a move to Discover would mean a new logo on the card and a new starting digits. So this is important because credit card account numbers from Discover begin traditionally with the number 6. Cards that run on Visa or MasterCard generally start with a 5 or with a 4 or 5. And so if you get a new card number, you will need to update existing credit card information whenever it's saved for automatic payment purposes. And so this is kind of important. You could also have a more limited card acceptance or benefits. And if your Capital One credit card is transferred to Discover's payment network, you may encounter difficulty when trying to use it outside of the US. That's because while MasterCard and Visa, again, the networks that currently service Capital One cards, enjoy widespread acceptance nearly anywhere across the globe, international acceptance of Discover is much more limited. So if you're planning to take a Discover card overseas, you want to pack a backup, you never know, just in case something were to happen. So one thing I also want you to really think about when we talk about the acquisition here is that, again, Capital One will be a formidable credit cards competitor. So, I mean, when it comes to all kinds of scenarios here, because the deal actually opens the door for Capital One to become the nation's largest credit card issuer by outstanding debt, outpacing JP Morgan Chase and Citigroup. So this is kind of important. So the company will remain based in McLean, Virginia, while maintaining a significant presence in Chicago, where Discover is based, okay? And it's one of those things where you have to look at size. We have to also look at the benefits to the shareholders, but also benefits to the card holders. So size-wise, Capital One is really going to get big here, okay? Now, while Capital One still holds contracts with Visa and MasterCard, for many of its credit products, it will move at least some of its cards onto the Discover networks over time. thus keeping a larger slice of the lucrative merchant fees its customers generate. I mean, this will make sense anyway, and this should be expected anyway also. And so, by owning a payment network, Capital One is poised to compete with its most direct competitor, American Express, and reduce its dependency on the two biggest players in global payments, Visa and MasterCard. So this is kind of cool. So the first thing is that, Capital One will actually remain a formidable credit cards competitor. And Capital One also is hoping to expand its digital banking reach, digital banking, because Capital One is the 9th largest bank in the US with both physical branches and an online presence. Meanwhile, Discover's banking presence is overwhelmingly online, but both are credit card first, banking second company. So they're banking second companies. So the acquisition won't change that, but it will enable Capital One to further expand into banking. And so what we see is that the deal will accelerate Capital One's banking business by allowing the company to tap into Discover's networks for banks. So this is kind of cool. And it's one of those things where Capital One and Discover, they both are trying to expand their digital outreach in a very significant manner. So this is kind of cool to see. Now, one thing you need to really understand here is that Discover will remain its own brand. So Discover will actually remain its own brand in the combined company, and they're not trying to really do some rebranding at all, because customers will understand that this is part of Capital One, but Discover will be its own brand. It's one of those things where you have to really understand Discover is currently a strong brand. So Discover cards don't actually charge annual fees, and they have a unique bonus offer. So this is kind of important. And but the bottom line here is that when you think about the deal overall, it's one of people are scared about the higher interest rates, because credit card interest rates are not much higher than in recent years, and this actually mirrors the broader rate environment when you think about it. So the average APR amongst credit cards that was actually incurring interest was about 22 to 23% in the fourth quarter of last year. And so when it comes to interest rate offers, bigger companies are not always better, at least not for consumers. So when you think about bigger companies, they tend to charge a lot more. Okay, so we're talking about going all the way to 30%. Now, Discover before the merger was already high when it comes to credit card APR. They were charging around 26%. Now with this merger, with the new size they are poised to have, chances are they might actually increase their average APR to 28 to 29%. Again, depending on how the deal is structured. Bottom line here is what? Big companies do tend to offer more generous rewards and discounts, like cashback and travel points, with their credit cards compared to small institutions. But the best perks are offered to the wealthiest customers, who make the most money through frequent and larger spending and merchants. So it's one of those things where you have to see what really works for you in terms of how you can position your finances vis-a-vis the new Capital One / Discover merger. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about what does the Capital One Discover deal mean to you, and I give you the review, and afterwards I give you the recap. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.